Well, good afternoon and welcome to our HighRock clients and any other listeners who have joined us this week. And thanks for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HighRock, who does some tremendous bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year. Our financial planner, Bianca Tomlinson, is also on the call, and I know that she's been working on lots of wealth forecasts recently, lots of new and returning clients, and lots of work for Bianca. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we certainly invite you to feel free to ask us questions. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About HighRock tab. Well, as we do each week, let's quickly recap our themes for 2016 before we get started on what happened over the course of the last week. Now, our overriding theme, as most know, is that financial markets will remain volatile. January and early February saw a fairly significant spike in volatility, but markets settled after that thanks to continued central bank monetary stimulus. There is still a great deal of uncertainty in the world, and as we move into June, there is little that has been resolved. In fact, it could be argued that there is more event risk uncertainty now than there was in the early part of the year. It just hasn't shown up in financial markets yet. The U.S. economy represents 20% of the global economy, and over 50% of the companies in our benchmark equity index are domiciled in the U.S. So we spend a good deal of our efforts trying to determine how the U.S. economy will evolve. At the moment, we see a growing chance of a recession in the U.S. in the next 6 to 8 months or thereabouts. Commodity prices, and especially oil, have been trending higher after a prolonged decline. Core inflation in North America has picked up a little bit, but not so much in other parts of the global economy where the deflationary trend continues, leaving inflation-guided central banks considering what to do next. Central bank monetary policy has been at the heart of keeping volatility in financial markets lower, but now financial markets are becoming obsessed with the next moves by the U.S. Federal Reserve, which is high on the list of event risks. Chances of a rate increase at the next FOMC meeting next week rose and then fell over a 2-week span, with monthly employment growth data showing its worst reading since September of 2010 after improved consumer spending the week before. The Fed wants to normalize interest rates, but either way, if the yield curve flattens, a recession will likely follow. There are still lots of geopolitical wildcards that can also cause event risk, like the UK leaving the European Union, US presidential election campaign, Middle East instability, Greek debt, Russian aggression, China, North Korea, terrorist activity, and the refugee crisis, and any one of these that contributes an additional shock to the global economy, or perhaps even some new issue that we don't yet know about. It could also be a catalyst for increased uncertainty. Bond markets provide the early warnings, and yield curve activity provides clues for timing and direction. And after a 4th consecutive quarter of negative earnings growth, earnings expectations continue to be lowered for 2016, leaving current stock prices at relatively expensive levels. The trouble is that impatient investors continue to search for growth and are making equities a considerably more expensive and risky asset class. The period from 2009 to 2014 was a time of better than average returns for balanced and diversified portfolios, but the cycle of economic activity has slowed, and the lack of growth and inflation are no longer providing those kind of returns. There is a tendency for some investors and traders to pursue greater risk to improve their returns. Now, we believe this to be a relatively poor strategy. In fact, we believe that investor portfolios need to be revisited and allocations adjusted to ensure that strategies are providing appropriate risk-adjusted returns consistent with the current investing environment. Okay, let's have a look at what's been driving markets over the last week. Relative to the beginning of the year, volatility has remained subdued for the moment, and it remains well below its long-term average. CNN Money's Fear and Greed Index hit a low near 9 in January, but has moved higher as central banks' easy monetary policy has encouraged investors to take more risk. Now it resides in the extreme greed zone. The markets have pushed up into overbought territory. We believe that the next move will take us back towards oversold levels. Since our last webinar, our benchmark World Equity Index is up by 1.6% and is now up 3.8% so far this year. Emerging markets were the best performance since last Tuesday. The Japanese Nikkei 225 index was the worst performer. And the TSX continues to be the best performing country index in the developed world this far. The Canadian REIT index has also done extremely well, but after such a great performance this year, we have sold off most of our REIT holdings, especially in light of the expected weakness in the Canadian economy. As our benchmark index tests the upper band of its downtrend from last year, we look to the volume statistics to gauge the strength of the breakout and see significantly lower volume behind the recent move. This prompts us to exercise caution. The one-year total return has been a negative 2.6%, and the 3-year a plus 6% return annualized. And if you combine the equity and bond indices into a balanced scenario, the one-year total return has been slightly positive for a 60% equity and 40% bond index combination. A positive 5.26% over 3 years and a 5.57 return over 5 years. For a less risk-oriented 40% equity and 60% bond combination, the one-year total return has been 1.64%, 4.89% for 3 years, and a 5.25% for 5 years. When you are comparing the return on your portfolio, don't forget to include your fees and MER costs. Well, fixed income markets were all higher, led by the U.S. government bond index. And natural gas led commodities higher once again this week, but copper, a bellwether for the global economy, was lower. The Bloomberg Commodity Index continues its new uptrend, and oil has been a major driver for that. Our benchmark World Equity Index is comprised of about 53% of U.S. companies, as I mentioned before, so we keep a very close eye on what's going on in the U.S. economy. But before we do that, a quick look at the polls for the U.S. elections show that Clinton's lead has narrowed significantly. Now, a Trump presidency would throw plenty of uncertainty, not only into the U.S., but also into the entire world. Meanwhile, the U.S. Federal Reserve meets next week to determine the next course of action. It appears that forecasters and financial markets have lowered expectations of a June interest rate increase as employment data released last Friday showed a surprising slowing of growth. The month-to-month numbers in this case, the lowest since 2010, are subject to potentially significant revisions. However, the long-term trend suggests continued slowing of employment growth. With a decline in labor force participation, the unemployment rate slipped to 4.7%. On our recession watch metric, this may have pushed our recession indicator out a couple of months. when the current level of unemployment intersects the 3-year moving average as it has signaled in the past 3 U.S. recessions, it could now be sometime in early 2017 before we see this situation reoccur. We shall continue to watch this metric closely. Meanwhile, second quarter U.S. GDP expectations have fallen to 2.5% growth from 2.9% growth. The broad and diversified benchmark equity index upon which we gauge the performance of our model and portfolio performance covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective. So we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. More than half of the companies are domiciled in the U.S. Europe has 16%, Japan has 7.5%, the UK has 6.5%, Canada has 3%, and China about 2.5%. And elsewhere in the global economy, we continue to monitor global debt as it reaches to new record highs. Now, after significant monetary stimulus from the European Central Bank, the Bank of Japan, the Reserve Bank of Australia, and the People's Bank of China, the results have yet to show much economic improvement. Deflation still remains a chief concern, and economic growth has really not emerged. The European Central Bank left its benchmark refinancing rate on hold at 0% on June 2nd, as was widely expected. Both the deposit rate and the lending rate were also left steady at minus 0.4% and at 0.25%, respectively. And the Central Bank confirmed it will start buying corporate bonds on June 8th. Policymakers reinforced that rates are expected to stay at present or lower levels for an extended period of time, and raise growth and inflation forecasts for this year, although warned that second quarter 2016 growth may be slower than originally had been anticipated. With less than 3 weeks to go until the UK referendum on remaining in the European Union, the polls are showing a less certain outcome. If they choose to leave, it is anticipated that the UK economy could suffer for some time into the future. That poll very close at the moment. Well, the British pound has been on a bit of a roller coaster ride as a result of this referendum. In China, the May manufacturing index slipped to 49.2. It remains in contraction below 50. Not good news for the Chinese economy going forward. Well, here at home, not a lot of new news, but on the back of a weaker U.S. dollar after the U.S. employment report and with continuingly higher oil prices, the Canadian dollar jumped back up over 78 cents U.S. Okay, so where do we see all of this leading us? Well, we take our look at the bond markets, and each week we do look at these yield curves to assess what the bond market might be telling us. A positive sloping yield curve, such as we see in the U.S., UK, and Canada, should give us some hope of better economic conditions in time as investors want to receive greater returns to protect themselves against future inflation. But a flattening yield curve tends to signal a greater chance of recession in the future. Negative yields, those below that pink zero line, indicate fear of deflation in the short term, where investors want the safety of government bonds for protection. The Japanese curve is now negative out to near 15 years. That means you are paying to own the safety of Japanese government bonds as opposed to them paying you to borrow money. That's not a good sign for the Japanese economy. Now, since last week, the U.S., the UK, the UK, the Canadian, and the German yield curves have all flattened, indicating that there is some reduced economic growth expectations in the bond market. So we have to keep a close eye on what's to come there. As for equity markets, well, as I say each week, investors buy stocks, and through that they buy a stream of future earnings. The price to earnings ratio represents a metric to measure stock prices relative to earnings. Now, the 10-year average price to earnings ratio is 14.3 times. The 12-month forward price to earnings ratio is currently at an expensive 16.8 times. Last week it was at 16.7, and at the highs of the equity markets a year ago it was 17.1. So stocks are expensive. And not only are prices expensive relative to earnings, but after the first quarter there have been 4 consecutive quarters of negative earnings growth, as I mentioned before, and expectations are that the second quarter will be the 5th. And earnings growth for all of 2016 will be less than 1%. It is hard to expect growth in equity markets when companies are not growing their earnings. Corporate profitability tends to lead the S&P 500 with a lagged effect. We see no reason for it being different this time. And stock markets do tend to fall during recessions. So what does it all mean? Well, for the last year, we have taken a cautious and defensive posture to investing, and in light of our key theme for 2016, and it has been fortuitous for our clients. We remain defensive because we see few, if any, good buying opportunities at the moment. We monitor a great many metrics that help us to determine where there might be some value, but until we are convinced that there is value, we will remain cautious. Cash and cash equivalents have been and continue to be important defensive assets. And as we discussed last week on the call, if we are able to return positive returns for our client portfolios by having more cash and less risk, it is a better risk-adjusted return that we're able to bring. Remember that the core of most client portfolios is a long-term strategy based on personal wealth forecast, goals, risk tolerance, and time horizons. However, the ongoing research and analysis we do at HighRock will dictate the minor adjustments in short-term strategy that we make in our models, which we believe will add value to the long-term performance. Rebalancing on a regular basis is crucial. Different asset classes will outperform or underperform at different times in a market cycle. Selling those outperforming assets and buying underperforming assets will continually add value and return. Underperforming assets will eventually return to better performance, while outperforming assets will ultimately underperform. This is how profitability is realized and the new cash reinvested. We also analyze each asset class to ensure that it is appropriate for each client's strategy. If an asset class like the Canadian Preferred Share Index attains a higher level of volatility and becomes less suitable, which it has recently, we will reduce our and your exposure to continue to maximize risk-adjusted returns. On BNN's market call a few weeks back, Paul identified 3 top picks of our models, and I'm going to ask Paul now if he has any updates for us or anything new that he'd like to add to the mix.
Thanks, Scott. Obviously, energy prices continue to move higher. You reflected natural gas has moved up substantially over the past couple of months, but obviously oil has as well. We're now closing over $50 a barrel on WTI. I think we can get up towards 55, 56. A lot of those energy bonds, like Athabasca oil bond that we see up there, was one of our top picks, and that's probably our largest position in the tactical model. Are what we would call bid without right now. They've gone from last fall and into January, early February, we're pretty much on the offer. They were offered without bids. Now today they're kind of bids without offers. So there aren't a lot of bonds out for sale right now. Everybody seems to want to buy them. So all those positions seem to be working really well, and I would just add, actually we pulled one of our other larger positions. We're up about 30% in the tactical model, and it's a high yield bond position, a very special situation that we know well. I won't mention the name on the call, but if any clients want more information on it, they're happy to call. And we just added another position in an energy name this morning, a very small weight, and it's much more speculative in nature that we won't add much more, if at all. We're actually having a meeting with the CEO on Thursday morning of the company we just bought. So anyway, things are moving quite well, and we've had some good success in the energy names. That's it.
Well, thanks, Paul. That's great. Keep up the great work. Okay, as we do each week, let's have a look and see what is coming down the pipe as far as economic data that we can focus on. We have tonight, in fact, we'll see the final reading on Japan's first quarter GDP. Not a lot of changes expected there, but we will be also watching the May balance of trade coming out of China. How imports and exports are faring is usually a fairly key part of the Chinese economy. Also, tomorrow we'll get UK industrial production for April. On Friday, we'll see the state of the Canadian labor market in the May labor force survey. And then on the weekend, we're going to see some industrial production numbers out of China for May. And then next Tuesday, we'll get a little bit of industrial production for the Euro area, as well as the latest reading on what the consumer is up to in the United States. So all sorts of interesting stuff for us, so as we monitor the global macroeconomic situation. Again, next Tuesday, we will have the HIROC webinar. The dates are incorrect there. My apologies. That will be June the 14th, next Tuesday, June the 12th for Sunday. But that's it for today's discussion, and if anyone who is listening might have a question, this is the time to ask it. Okay, if you do have questions and would like to email them to us, we would be more than happy for you to send them. We also love to get your feedback on these webinars, what you think is good, what is not, or what you might like to see us cover that we don't cover. So, as always, thank you for taking the time to tune in. Have an excellent rest of the week and a great weekend, and don't forget to tune in next Tuesday, and that is, again, June the 14th. But until then, this is Scott Tomlinson signing off.